Welcome to This Explainer. We're going to dive straight into a genuinely fascinating structural debate in the world of finance today. We're unpacking the source material on exactly why public banks absolutely need fundamentally different rules than commercial banks if they're actually going to succeed. We usually just assume a bank is a bank, right? And so one set of rules should govern the whole shebang. But as we'll see, applying commercial rules to a public institution, well, it's kind of like trying to play chess using the rules of checkers. It just doesn't work. So, I want you to start by asking yourself this. What if a bank was run exactly like a public water utility? Just imagine it for a second. A financial institution designed from the ground up for pure public stability, rather than squeezing out maximum quarterly profits for private shareholders. What would that even look like? How would it run day to day? And crucially, how would we need to regulate it to keep the water, or in this case, the money, flowing safely and reliably to the community? Here is our roadmap for today. We're hitting 5 key areas. 1. The rulebook mismatch. 2. The North Dakota model. 3. Banking as utility. 4. Tailored rules for safety. And finally, number 5, capitalizing public banks. Okay, let's jump right into section 1, the rulebook mismatch, private versus public rules. Right at the heart of this whole debate is a really fundamental conflict. Think about it. Most existing banking rules were written by and for private banks. They're heavily driven by the Federal Reserve and the Bank for International Settlements framework. The thing is, these rules were quite literally never designed with a public utility in mind. They deeply embed the specific priorities and, let's be honest, the conflicts of interest of private banking. So forcing those exact same regulations onto a public bank, it wouldn't just miss the mark, it would actively break the machine. And here's why applying that private rulebook is so dangerous. The private banking system, under its current regulatory setup, historically triggers recurring bubbles and crashes, on average every 6 to 7 years. It is an inherently volatile system. So the data really poses an obvious question for us. If a public bank's entire goal is long-term economic stability, why on earth would we force it to use a framework that routinely guarantees the exact opposite? Which brings us to Section 2, the North Dakota model, a century of safety. To see how a different framework actually performs in the real world, we don't have to rely on theory. We have the Bank of North Dakota, 19.3%. Think about that number for a second. That is their average return on equity over the past 24 years. It's a pretty stunning figure, and it totally shatters this myth that a publicly run utility model can't be financially robust. The BND has survived recessions and stabilized local economies for over a century now, even posting record profits during the 2008 crash, all by playing by a completely different set of rules. Now, notice what is deliberately missing from their governance model. The BND has actually never been regulated by the state banking board. Instead, it's governed by its own specific statute, overseen by 3 elected officials and an external advisory board. This statutory independence is absolutely the secret to their century of safety. It proves, without a doubt, that a bank can be intensely regulated without falling under the conventional commercial umbrella. All right, Section 3, banking as a utility, how the BND actually operates. So how exactly does a public bank operate differently from that commercial bank sitting on your corner? Well, it really comes down to the type of lending they do. The Bank of North Dakota strictly engages in productive lending. We're talking supporting industry, commerce, and agriculture. They explicitly do not touch speculative lending, things like funding the purchase of existing real estate or trading stocks. By entirely avoiding speculation, they completely bypass those nasty asset inflation cycles that constantly destabilize private banks. And because they treat banking as a public utility rather than a profit-maximizing enterprise, their overhead is just incredibly low. There are no massive advertising budgets, no sprawling networks of retail branches, no ATMs to maintain, and definitely no hidden fees to extract from customers. When you strip away all of those bloated retail banking expenses, that saved capital feeds directly back into that massive 19.3% return on equity we talked about earlier. It's a true game changer. Their relationship with other banks is totally different too. Instead of competing, they practice what's called partnership lending. The BND participates in productive loans right alongside local community banks and credit unions to actually strengthen them. And here's the best part. During economic crises, the BND steps in to purchase troubled loans. It acts as a crucial lifeline, keeping local financial institutions solvent when times get really tough. All of this builds into a really brilliant self-sustaining ecosystem. By law, all state deposits are held at the Bank of North Dakota. This keeps public money safely in-state, allowing the bank to instantly recycle those massive funds directly back into local lending. So instead of Wall Street skimming off the top, the tax dollars the state collects are used to fund the exact local economy that generated them in the first place. Moving on to Section 4, Tailored Rules for Safety, built for public safety. If we want public banks to work, we really have to reframe things that commercial bankers might see as weaknesses and recognize them instead as deliberate structural safety features. Take FDIC insurance, for example. Commercial banks face the very real risk of bank runs, right? So the FDIC is essential. But the BND has zero FDIC membership. Why? Because the state itself is the primary depositor, and a state is obviously not going to make a run on its own bank. Plus, standard FDIC insurance caps at $250,000. That limit is completely irrelevant when you're managing massive state government revenues. Ironically, standard FDIC capital rules can actually harm a public bank's core mission. Think about an economic downturn. A public bank's job is counter-cyclical lending, stepping up, expanding lending, and rescuing the local economy. But FDIC capital rules are specifically designed to restrict lending during downturns, so forcing those rules on a public bank would literally prevent it from doing its job exactly when the public needs it the most. Similarly, we've got the issue of collateral. In private banking, holding public deposits often requires 100% collateral just to protect the government's money from private risk. But for a public bank, requiring 100% collateral is fundamentally unnecessary. There is literally zero conflict of interest between the bank and the state because they are the exact same entity. Forcing a public bank to post 100% collateral just to hold its own money would make launching the institution impossibly prohibitively costly. All right, our final stretch, Section 5, Capitalizing Public Banks, Funding the Utility Model. So if cities and states recognize the value of this model, how do they actually fund it? Any viable public bank legislation absolutely must explicitly authorize practical capital formation mechanisms. The BND itself was launched using bonds. Today, modern states and cities need the legal flexibility to use revenue bonds, general obligation bonds, state pension funds, or pooled funds to capitalize these institutions. If the legislation doesn't explicitly unlock these existing tools, the bank just stays a theory on a piece of paper. And we actually have a modern cautionary tale of what happens when you get this wrong. California recently attempted to pass public banking legislation, known as AB 857, but the effort was effectively crippled. Why? Because the legislation stripped away those flexible funding options, and worse, it imposed those strict FDIC and collateral requirements we were just talking about. By forcing a private banking rulebook onto a public initiative, they smothered the banks before they could even form. But when it's capitalized correctly and governed by the right statutes, a public bank provides immediate public benefit. It doesn't take years and years to become profitable. The Bank of North Dakota generates revenue right out of the gate by lending directly to the state at low interest rates and refinancing state bonds. This creates instant financial efficiency for taxpayers. It's a real win-win. Which really brings us back to our core thesis today. As the source material emphasizes, public banks must be governed by statutes tailored to their mission and structure. Listen, this isn't an argument against regulating private banks. Strong regulation of the financial sector is absolutely crucial, but the regulations must fit the institution. Public banks operate with totally different goals, different risk profiles, and different deposit structures. Therefore, they simply must be governed by statutes uniquely tailored to their specific mission as a public utility. So I'll leave you with this final thought to reflect on. We know the private banking system, governed by its current rules, leads to structural instability and reoccurring crashes every few years. Knowing that a proven, highly profitable, and intensely safe alternative exists right now in the public utility model, is it time to reimagine the financial system in your own state and build a bank that actually works for the public? Thanks so much for joining me for this explainer, and keep asking those big questions.